our market master for the day. Saurabh Mukherjea, CEO, Institutional Equities at Ambit Capital, joins us now. Saurabh, good morning. Thank you very much. You can't have come at a more appropriate moment. What is the overall sense you're getting about the Indian markets? Like I told you, two major contradicting forces. One, our macros are getting reset for the better, but will the liquidity flow? Is the risk appetite now waning?
I think the main things investors are focusing on firstly is the election results on Sunday 19th, and thereafter most of us are really keeping our fingers crossed that in the 6-7 weeks after the Maharashtra and Haryana elections, the Prime Minister will finally settle down in office in Delhi and will start seeing administrative reforms. Because honestly, last 4 or 5 months, whilst they've been great profile raiser for India, it's been a sentiment changer and a sentiment booster for India. In terms of reforms on the ground, reforms in Parliament, we haven't actually seen that much. So 19th, results will be out of the way, and thereafter we're looking at 4, 5, 6 weeks of hopefully flurry of governmental activity in New Delhi, which will actually give some substance to the rally that we have seen over the last 12 months.
Yeah, unless that happens, you won't be a buyer. I mean,
I think the concerns regarding FY16 growth will become a little bit more accentuated unless we start seeing some movement on the ground in terms of policy. Because remember, we haven't seen any infrastructure project of note take off in the last 5 months. It's not as if the industry, the IIP data is roaring away. Neither is credit creation rocking. So there's multiple grounds for believing that the economy is still very soft. And without reform, that economic growth rate isn't going to pick up very quickly. So this year's growth of around 5.5% is all right. Question is 16. Can we get towards 6, 6.5 and 16? I think that's a pretty big question mark. And that's what will drive markets from November, December onwards, I think.
Saurabh, hi, morning. What are the legislative reforms that will, keep the market happy? I mean, people are talking about GST, land acquisition, etc. But if you had to list down 2 or 3 reforms that the government should get to right now, what will they be?
I think firstly, I think what is clear is that the budget will be a big event, in the sense that I don't think the 10th July budget delivered by any stretch of the imagination, regardless of what hoopla followed in the aftermath of the 10th July budget. I think that was a damn squib, but one has to be fair to the government that barely been in power for 6 weeks at that point. So therefore, the February budget becomes an important event. I think the critical thing we'll be looking for is fiscal discipline and a restatement of the FRBM. Can we go back to a fiscal responsibility act which will give investors confidence that India will stick to the road of fiscal discipline, come what may. Leaving the budget aside, labour reforms, land reforms, GST. I think these are the 3 big headers that we're looking at. Labour reforms, the Industrial Disputes Act in particular. What's giving us grounds for hope is the government has already said that there'll be an amendment in the Small Factories Act. The amendment will be tabled in the winter session. But the Industrial Disputes Act is the big one. And will the government be able to table that in January, February? Land Acquisition Act, amendment for that, because as you know, pretty much all land acquisition activity has ground to a halt in India over the last 12 months. And finally, GST. We need the constitutional amendment. We need more progress on drafting. We need the states to sign up. So plenty of work left to be done. And that's why I think post 19th of October, we really are keen to see this government settle down in office and get its foot on the table and start moving on the reform front.
Morgan Stanley wrote a report exactly on what you are saying, but they came to the exactly opposite conclusion. Their recent report is that there is a lot of executive decision making that is happening in terms of clearances. As well, inflation. They're pinning their hopes on the fact that this trajectory will continue. And at that time, the inflation number had not even come out for September. Purely because the macros are correcting and because executive implementation is happening at a ground level. Even, we heard about the NREGS tweaking as well. So their argument is that even without land, labor, and they specifically mentioned these acts, even without land, labor and GST, 6.5 is a given for FY16. You're not buying that?
I mean, I would love to believe that point of view. It's just that the visits that I have made to Delhi over the last 3 or 4 months don't suggest a flurry of executive activity. I think there's a lot of activity going on, but whether it constitutes administrative reform, I'm not so sure. So if you take, for example, the whole situation around PPAs, the power plants which are stuck with suboptimal PPAs, I don't think that's changed materially. If you take the DISCOMs as busted balance sheets, I don't think that has changed materially. And I could go on and on about non-legislative issues which are still hanging fire. On the food inflation or the general inflation point, I think we'll be helped by base effects in 3Q. But 4Q, it is pretty clear that the base effects will roll back in the opposite direction, in an adverse direction, and we'll be back with 8% inflation, CPI 8% in 4Q. Remember, falling crude really doesn't have that much of a bearing on CPI. Barely 10% of CPI is driven by falling crude. So with the RBI itself saying that its Jan 16 6% target still looks a bit difficult to reach, I think tight monetary policy is a given for the rest of the fiscal. So that really can't support growth. So growth, therefore, has to be sustained by initiative from Delhi, which hasn't yet sort of materialized to the extent I think we were hoping.
Well, there is all of this on one hand, and on the other hand, there is this overarching worry about the global slowdown that could, derail our markets as well. How worried would you be about the global weakness denting FI demand in India?
I'm less worried about that for a couple of reasons. I think if you take the American economy, which really is the mainstay of the global economy, that seems to be in pretty solid shape. Yes, there's weakness in China, but there's been weakness in China for the last 4 years from what I can make out. There's been weakness in Europe, but hey, what's new there? So if commodity prices stay broadly where they are, sustained fall in commodity prices will have a negative effect on India, because that will lead to the whole capital goods environment globally turning very adverse, which in turn will have a bearing on India's exports. But if commodity prices broadly stay where they are, the US continues recovering, even with the Fed tightening, I'm not that worried about the global outlook for India. I think the main story in our country is we are in the midst of a slow macroeconomic recovery with some policy initiative that can be given a bit of a thrust. Monetary policy will stay tight because inflation still persists as an issue. But overall, the macro backdrop is pretty solid. The fiscal position looks better than it has for at least 4 years. And I don't think macro really is the key source of concern. At the moment, I think what our clients are looking at is, can we see some reform activity which gives us courage gives us hope about 16. That 6.5% number for 16, I don't think is a given. And that's where I think a lot of investor activity attention focuses on.
Okay, so pending government action, what will you be buying?
I think the sectors which we continue to recommend to our clients are with the keeping of our grain of our good and clean portfolio. Sectors such as auto ancillaries, well-run, cash-generative.
But even auto ancillaries should be impacted by Europe looking weaker than it did a quarter ago.
Agree, Lata, but I think that's been the case for the last 3-4 years. I think Europe's structural weaknesses now are well understood. What we are seeing in sectors such as auto ancillaries is really that places like Southeast Asia, Africa, Latin America.
So all auto ancs, I mean, is it Bharat Forge?
So specifically the names that we've been highlighting to clients for a while now is Balkrishna Industries in off-highway tires. I think Bharat Forge increasingly looks well placed in its forgings with its forgings leadership. Motherson Sumi's had a great run. Coming back to core auto, something like Ashok Leyland in CVs, TVS in motors, even Bajaj Auto as a straightforward play on a consumer recovery. I think Bajaj Auto is a good name. So that sector continues to be a favorite of ours. Moving away, the general theme of manufactured exports. I think this is one sector with the rupee having slid by 70% against the renminbi in 5 years. I think our competitiveness vis-a-vis China has been transformed. 70% depreciation in the rupee versus the RMB. So names such as the Triveni turbines in the light manufacturing sector, even a TTK Prestige with growing export volumes, AIA Engineering with its high chrome metallurgical exports. So there's a whole broader light manufacturing sector which will do well. And I think what's very encouraging, specialty chemicals seems to be joining the story. As China tries to withdraw from bulk chemical exports or tries to throttle back on bulk chemical exports by tightening environmental rules, companies like PI Industries, the specialty chemical exporters, look like a very interesting space. So auto is one major theme. I think the light electrical exports or the light manufacturing manufacturing exports, as I call them, will continue to be a very, very big theme in the next 2 or 3 years.
Okay, I noticed you very smartly avoided Lata's question on DLF. I know you don't track that stock, but what's your view on what investors should be doing? Because, you know, this is still a company that has lucrative assets. So at this price, would you, you know, stick your neck out, buy it, or do you think it's a complete avoid?
Okay, so let me not duck the difficult question. The reason we don't cover a range of these stocks is wherever politics and policy have such a bearing on a company's fortunes, we find it very difficult to reach a stable view on these names. So you know, there's in sectors such as power and infra, metals, mining, oil and gas, there's a range of such names where their fates are so tightly linked to regulation, political activity, that it's very difficult for us to, you know, recommend these stocks to clients, because in effect what we are asking clients to take a view on is big regulatory issues on which we really have no control. And as a result, I think when you're buying names such as this, you're buying a lot of political risk, a lot of regulatory risk, and hence our inability to give any strong views, and hence my reluctance to sort of take that question.
Well, where regulatory risk is the least, IT stocks, and we have a question from a money control viewer on that. This one comes from Rohit Jain. He writes to us from Kolkata. He says he has some investments in Tech Mahindra, which he bought at a price of 2350 rupees a share. Wants to know the future prospects of this stock. Might I add other IT companies that you like?
Right. So I think the IT space continues to be nicely placed with the US economy recovering, with there still being plenty of scope for labor arbitrage. I think the space is nicely placed. We have to continue saying that HCL Tech remains our favorite bet. I think the way they've repositioned the company in remote infrastructure management, the way HCL Tech has repositioned itself in the last 4 or 5 years in remote infrastructure management, convinces us that amongst the frontline IT plays, this is the one with the cleanest and clearest growth prospects. If you had to choose one large liquid name in IT beyond HCL Tech, I would go for TCS. It has become a scale leviathan. In a way, in effect, it's adding every 4 or 5 years another, almost like it's adding a mid-cap IT company to its market cap every 4 or 5 years. So I would keep it simple in IT, focus on HCL Tech, focus on TCS. There's enough there for you to play in those two stocks. If you want to go down the market cap spectrum and take mid caps, I think Tech Mahindra is a perfectly fair play for you to consider in mid caps. But my point of view would be to keep it large, keep it liquid, because it is a large macro story which will continue playing out for many years. HCL Tech and TCS will give you enough returns.
I like that. Keep it large, keep it liquid.
Well, I wanted to ask you about Sintex as well. That's been a big gainer after its numbers, and we are in fact speaking with the management after the break. You can stay on if you like to. But what's your view on the company?
So again, we've wrestled with our coverage on this. We sort of thought about covering and then shied away. We still haven't quite understood what exactly the capital allocation plans are. 6, 7, 8 years ago, this was a lovely mid-cap stock, clear focus on plastics, on running a tight company. And then, in the last 6, 7 years, they've done so many things that one sort of struggles to recall what exactly they stand for. I think they even got involved in bidding for a power plant once. They bid for a NELP block. They entered auto ancillaries. So all manner of diversification and capital allocation being spread all over the place took place. The balance sheet got damaged in the process. So we're slightly skeptical about companies where the capital allocation becomes indisciplined. If the company comes back to the straight and the narrow in terms of paring down debt, focusing on resuscitating cash flows, and focusing on running a tight focused business, then we'll obviously be interested. But until that time, we'll wait and watch as to how Sintex goes.
All right, Saurabh. Pleasure speaking with you.
Thanks a lot.
Thank you very much for joining us. Well, I think we didn't ask you this. What's the bottom for the market now?
So look, our year-end target for the SENSEX remains 30,000. I would say downside risk in the event of policy not materializing in the manner we quite hope would be, I think, something like 10% downside risk is probably the main risk. And that's not, I think, global macro. It's about our own policymakers.